Yes, you read the title right. This video is not theoretical, nor is it based on a book. This is a practical video in which I'll analyze some of the most popular stocks out there: Apple, Microsoft, and Tesla. I'll look at these sought-after companies through my lens of value investing to see where I'd be most likely to put my own money today. The winning stock will be crowned the King of the Hill. Before we get to the stocks, let me present the framework that I use to evaluate publicly traded companies. This process has been refined over a decade of beating the market, and after reading some 100 books on investing, so I hope you'll like it. What is it and how does it work? In short, it's made up of 3 parts: growth, distributable cash flows, and multiple change. It's these 3 that create returns for us as shareholders. Let's go through them one by one. Growth. Here, I aim to determine at which rate a company will grow its revenues for the next few years. I typically combine a bunch of quantitative and qualitative metrics to get to this figure. First and foremost, I look at the company's historical growth to see if that can be extrapolated into the next few years. Secondly, I look at what the company's management says about the future, guidance, forecasts, and so forth, as well as any analysts' expectations. Last but not least, I try to understand the development of the industry and the ecosystem in which the company operates, and if there are any megatrends that one needs to account for, as it's usually easier for a company to grow 10% in an industry that grows 12% than to grow 5% in an industry which is in a structural decline. The second part is distributable cash flows. It's quite similar to what Warren Buffett calls owner earnings. It's basically the surplus cash that a company creates that could potentially be distributed to us shareholders via dividends or share repurchases. The point is to account for the fact that some companies are very cash efficient, while others must reinvest all they have just to stay afloat. The third and last component I consider is the valuation or the multiple change. Here, I use key ratios such as EV/EBIT and PE, comparing the company's current valuation to its historical figures and to its peers. These figures only act as a starting point though. I don't always agree with Mr. Market's assessment of what should be pricey and what should be cheap. After also estimating a future profit margin, I end up with a gap between today's valuations and where I think that the company should actually trade. Then I simply sum these 3 together. Growth plus distributable cash flows plus multiple change equals to yearly return for the stock. The standard period that I currently look at is 3 years. After that, only one thing remains, but it is important. I add a risk profile to the stock to ensure apples-to-apples comparisons. The risk profile tries to answer the following: how high is the probability that the results are materially worse than I've just calculated? I also try to ensure that the investment has a high probability of surpassing a 10% average return, which is what one could have achieved from investing in an index historically. I might prefer a stock where I think I can get a very safe 15% return rather than speculating on another where I might get 25%. This could seem like a lot to process, but I'm sure you'll get the hang of it once we've applied the method to Apple, Microsoft, and Tesla. By the way, this approach has been co-developed with a friend and colleague of mine. He has helped me in making this video possible, so from here on out, I'll use we instead of I. Credit where credit is due. Let's dive right in. Oh, and yeah, this is the Swedish Investor, bringing you the best tips and tools for reaching financial freedom through stock market investing. Let's start with the most valuable company in the world, which also happens to be Berkshire Hathaway's best investment ever in terms of dollar returns. But what can we expect going forward? Let's just start by acknowledging that Apple is a behemoth. Size to a company is what gravity is to the human body. It pulls you down. In the last 10 years, Apple has managed a compound annual growth rate, or CAGR, of 8.5%. We'll use this as a maximum limit for our projected future growth, as it's incredibly rare for a company of Apple's size to accelerate. Apple is a well-researched company, and there are plenty of analysts to lean on for making assumptions. About 20 of them estimates that Apple will grow by 6% per year in the coming 2 years, on average. Half of Apple's sales are made from the iPhone, making it their most important product. The global smartphone industry is expected to grow by 4% per year until 2030, according to the research company Spherical Insights. Apple's market share is around 20%, according to Statista, and has remained fairly stable for some time, although it seems as if they've gained some market share in the most recent years. Apple's ability to retain their customers is well illustrated by Warren Buffett.
And if they had to give up a second car or give up their iPhone, they'd give up their second car.
Based on a 4% expected industry growth rate, Apple will need to fuel its growth from its other product and service categories to perform anything near its historical average of 8.5%. And so, after combining these data points, we end up with a 6% expected growth rate for the next 3 years, which is higher than the smartphone market as a whole, slightly lower than Apple's 10-year average, but in line with the analysts' forecasts. The launch of the new goggles and some help from AI momentum might do it for the company. In terms of Apple's distributable cash flows, they have made repurchases of stock of almost 5% per year during the last few years. They have slightly increased their net debt while paying a small dividend. These two basically cancel each other out, so in total, Apple has produced about 5% in distributable cash flows during the last few years. We don't have any reason to believe that it will change materially in the next few years. Apple currently trades at EV/EBIT 24 and PE 30. This is higher than their 5-year historical averages of EV/EBIT 20.5 and PE 26, and much higher than their 10-year averages of EV/EBIT 15 and PE 20.5. As mentioned before, we like to compare a company's current valuations to both its historical averages and to competitors. In the case of Apple, it's quite difficult to find good peers though. There are some Chinese ones, but they are materially different as investments due to the political risk. Comparing to Samsung could also be a little bit misleading, as Apple's moat can be considered much higher due to a stronger brand and lock-in effects with the ecosystem. So we don't really get any help there. Why is Apple currently trading much higher than its historical averages? And is it justified? Much of the expectations revolve around AI and the goggles. But with analysts still expecting Apple's growth rate to be lower than their 10-year historical average of 8.5%, there really is no reason for us to pay more for each dollar earned today than we did the last few years. Also, we don't expect the margin to help. There are no reliable trends here. With nothing to fully justify the current valuation, we expect Apple will return to its 5-year historical average of EV/EBIT 20.5 and PE 26. Remember that this is still much higher than the company's 10-year historical average, even though the growth rate in the coming decade is expected to be lower than during the previous one. If we are correct, Apple will experience a multiple contraction of 7% per year in the next 3 years. We think that our assumptions about the coming 3 years are quite conservative, and the risk that the outcome will be materially worse than those assumptions is small. Apple could take a hit if we are in for a recession, but it would recover quickly if that happens. All in all, with these projections, the risk profile for Apple is low. Now we add those numbers together to get our expected 3-year CAGR. 6% from growth, 5% from distributable cash flows, and minus 7% from multiple contraction. It equals 4%. So Apple gets a 4% expected CAGR with low risk. Well, it is something, but it doesn't really make you drool. Don't get me wrong here, by the way. Apple is one of the greatest companies in the world. It's not the company that we have an issue with here, but rather the price of Apple's stock. We'd happily put up a ton of our money in this company if only it would trade at lower multiples. And yes, we know that Apple currently represents a huge portion of Berkshire Hathaway's publicly traded portfolio, but we do not think that Warren Buffett would buy Apple at today's levels. He's usually not fond of PE ratios of 30. Buffett bought Apple between 2016 and 2018, when its average PE was 15 to 16. It has been Buffett's greatest investment ever in terms of dollars. So why doesn't he sell? Well, for a number of reasons. The expected return still doesn't look terrible, It's probably in line with what we can expect from the general market in the short term due to today's high valuations. Also, Buffett rarely sells quality. He's a buy and hold type of guy these days. With currently no other contenders, Apple is now king of the hill. Let's see if it remains there for the whole video. By the way, after we've presented Microsoft and Tesla, as a bonus, I'll compare the winner to one of my own stock market holdings, one that we believe can return
Wait for it. Wait for it. Wait for it.
22% per year for the next 3 years. So, the winner among Apple, Microsoft and Tesla will be up against some tough competition. Okay, next up is Microsoft. Can it beat Apple? Let's see. Starting with growth, the 10-year historical average is 10.5%. Even more impressive is that the growth rate seems to have accelerated during the last couple of years. Just as for Apple, plenty of analysts are doing their best to forecast Microsoft's growth. For the coming 3 years, they expect the company to advance by 13% per year. This is probably fueled by some AI hype. Microsoft's 2 largest segments, cloud services and the Office package, could benefit from this quite a bit. About 1/3 of Microsoft's sales come from these cloud services and Microsoft Azure, which makes it their single biggest revenue stream. Microsoft has about 25% of the market and has grown by an average of 28% in the last few years. They compete very well and have gained market share. There are a lot of different forecasts for this market, but a good ballpark number is 15% CAGR until 2030. So, this segment will probably continue showing healthy growth numbers in the foreseeable future. Regarding operating systems, Windows remains the market leader by a wide margin. Mac OS has roughly doubled its market share to 20% during the last decade, but we think that Apple only poses a moderate threat. Regarding Microsoft's other segments, finding industry growth numbers is difficult. For Office, Microsoft more or less is the industry. Anyways, after combining the data that we've got, we project a 12% growth rate for the next 3 years. That's in between what analysts expect and the historical growth rate numbers. Again, an increased size acts as gravity, and normally we wouldn't dare to adjust the historical growth rate upwards for a company this large. Still, we can make an exception, with both the recent acceleration in mind and the analysts supporting this. During the last few years, Microsoft has made yearly repurchases of more than 1% of shares outstanding and had dividends of roughly 1%, while slightly decreasing the net debt level. In total, Microsoft has had distributable cash flows of 2.5%, which is what we expect for the next few years as well. After this year's rally, the price tag for Microsoft is EV/EBIT 26.5 and PE 33. We can compare this to their 5-year average of EV/EBIT 26 and PE 31.5. What about the profit margins? Can they increase so they can help bring the multiples down? It doesn't seem so. They are at the highest levels the company has achieved in a 20-year timeframe, 42%. Although margins are at their peak, they have been there for a few years now, so we have no reason to believe that they will come down anytime soon either. We therefore use today's top margins in our projection for the next 3 years. There is a lack of competitors to compare Microsoft's valuation with, so we'll have to lean on the company's historical valuations in relation to its operational performance. During the last 5 years, Microsoft grew by about 15% per year. We project that this growth will now come down to about 12%. Therefore, we believe that the valuations must also come down a little bit below their historical averages. The transition from today's level of EV/EBIT 26.5 to 25, a little below the 5-year average, equates to a yearly contraction of about 2.5% for the next 3 years. We think that the assumptions here are somewhat more aggressive than for Apple, but they still err on the side of caution. We assume growth to be higher than historically here versus lower for Apple, and we assume peak margins will remain for Microsoft versus using historical averages for Apple. One might question if it isn't riskier to assume EV/EBIT 25 for Microsoft while only using 20.5 for Apple. We think, yes, it is a little bit riskier, but not much. We think that Microsoft deserves a higher multiple because it is expected to grow faster and it is less sensitive to economic cycles, which might be useful in the next few years. As the financial crisis proves, Microsoft's operations are resilient to recessions. During 2008-09, the company lost only a few percentage points in sales. And these days, an even larger portion of Microsoft's income is of a recurring character, so that should only have improved. Moreover, we think that Microsoft has a slightly wider moat than Apple. Don't get me wrong, Apple has quite a brand name and high switching costs. However, some of Microsoft's core businesses, like the Office products and the operating system, are almost like monopolies. They've had market shares of above 70% for decades. You'll notice a difference if you examine the 10K reports of Apple, Microsoft, and Tesla. We'll get to Tesla later. Apple and Tesla mention extreme competition, intensifying competition, etc., etc., while Microsoft takes a much vaguer stance, talking about how they differentiate themselves primarily, and sometimes, at maximum, using the word intense to describe the competition. All in all, the built-in risks in our assumptions are higher than those for Apple, but not by much. Adding together the 12% return from growth, 2.5% from distributable cash flows, and minus 2.5% from the contracting multiple, we end up with 12%. This is not uninteresting. If Microsoft can achieve this, it will probably outperform the market over the next few years. Given that our numbers are correct, Microsoft will beat Apple by 8% per year in the coming 3 years. We believe that the difference in risk profile doesn't make up for this, and therefore, Microsoft is now the king of the hill. Next up is Tesla, and no further presentation is required here either, I guess, so let's dive in. There is really no point in looking at Tesla's historical growth rate, as that is virtually impossible to replicate. Instead, we'll focus on the forecasts made by analysts and combine that with the industry's expected development. Plenty of analysts are covering Tesla too, and they believe in an average growth rate of 25% for the company during the next 3 years. Tesla has a market share of roughly 20% of the electrical vehicle market. That's similar to what they had on a 12-month rolling basis a year ago. There are a lot of different figures out there, but a 25% CAGR from the industry in the next 3 years seems to be a good ballpark figure. Given that Tesla continues to hold its 20% market share, the industry estimate of 25% growth is also what Tesla should perform. Therefore, we project a 25% yearly growth rate for Tesla in the next 3 years. It's higher than both Apple and Microsoft, but that really shouldn't surprise anyone, given how explosive the EV industry has developed lately. Determining the amount of cash flow that Tesla could distribute is not straightforward. That's partly because they have only been profitable for a very short period of time, and partly because their growth rate costs quite a lot of money. If we use the last 1.5 years, which is the time that Tesla has had double-digit margins, shareholders have been diluted by about 4.5% per year, partly offset by a reduction in net debt of $8.5 billion, or approximately 1% of the current market cap. There's been no dividends. All in all, Tesla gets minus 4% per year from distributable cash flows. The fast growth in this hardware-dependent industry will always require quite a lot of capex and inventory buildup, which ultimately dampens the potential. In the future, as Tesla's growth rate starts to diminish, the distributable cash flow should start to have a more positive impact on shareholders' returns though. Currently, on a trailing 12-month basis, Tesla trades at EV/EBIT 61 and PE 70. Now, that is a stratospheric valuation. Tesla competes with incumbents such as Toyota, Volkswagen, Mercedes, BMW, and GM, and these companies all typically trade in the EV/EBIT 9 to 15 range. No, this is not an apples-to-apples comparison, but the truth is that that is what Tesla can expect at some point in the future. EVs can only grow at the cost of combustion cars for so long, because the car industry as a whole doesn't really grow. Last year, Tesla traded at an EV/EBIT multiple of 51 on average, which was based on the expectations of 25% growth per year for the coming 3 years. But the growth rate will almost certainly slow down, and the multiples 3 years from now should reflect that. From there, the growth should be 20% or lower, or Tesla must gain market share, which doesn't seem too likely. Now, what multiple is 20% growth worth? It's hard to say an exact figure, but 3 years from now, we believe EV/EBIT 40 and PE 50 should be generous. The analysts expect the operating margin to be about 16.5% in 3 years, which will help bring the multiples down by increasing profits. But all in all, with these assumptions, the multiple will contract by about 8% per year during the next 3 years. Now, risk. Pretty much all the assumptions that we've based our Tesla valuation on are riskier than those for Microsoft and Apple. The 25% growth rate could be interrupted by a number of reasons, such as a recession, tougher competition and a loss of market share, slower growth in the EV industry than currently expected, and a cease of subsidies, which the EV industry is still very dependent on. A Tesla bull would probably argue that the self-driving business has an unknown upside. Tesla claims that competitors are miles behind in self-driving capabilities. But this is another situation where we cannot tell if that's true. And even if competitors are 1 or 2 years behind right now, and if it would be such a value driver, which Elon claims, full self-driving and all necessary regulation for widespread adoption still seems to be at least half a decade away, and those extra profits must therefore be heavily discounted. Besides, who's to say that Tesla will still be in the lead 5 years from now? Or that self-driving will even have a positive effect on the industry as a whole? You've probably heard that cars are parked 95% of the time. Self-driving might well remove this bottleneck and inefficiency, and we think it's difficult to forecast how that will affect auto manufacturers. Then we have the valuation. Not only is Tesla's EV/EBIT 40 in 3 years high relative to other auto manufacturers, but it is also high compared to Microsoft and Apple. Take Microsoft's EV/EBIT 25, for example. In 3 years, we think it's likely that Microsoft can grow by some 10% plus. It would still be impressive if Tesla only managed to grow by 15%. And if that would be the case, would Tesla even deserve a higher valuation than Microsoft, given Microsoft's wider moat, higher cash flow generation, and the fact that the company isn't as cyclical? Maybe not. And a Tesla at EV/EBIT 25 in 3 years would hurt shareholders' returns a ton. With a market cap of $784 billion, Tesla is valued like most of the other auto manufacturers combined. Remember that Tesla has about 20% of the EV market, and these other companies together make up the other 80%. Tesla having a market cap like the other 80% combined is unsettling, to say the least. Tesla is like a speedboat that has managed to secure a head start. They forced a whole industry to change direction, which is an incredible accomplishment. But the incumbents, or the mega ship in this analogy, have now managed to turn around and are picking up speed. We can only conclude that Tesla has no room for error at EV/EBIT 40. As if that wasn't enough, the expected 16.5% margin is the highest that the company has ever performed historically. With increased competition and continued investments, who's to say that they'll manage to perform that long term? With a 25% growth rate, -4% in distributable cash flows, and -8% in multiple contraction, we end up with a 13% yearly return for Tesla for the next 3 years. So, is it better than Microsoft and its 12% CAGR? Not so fast. Warren Buffett's first rule of investing is to never lose money, and his second rule is to never forget the first one. There are too many uncertainties that could potentially ruin it for us in the Tesla case, and we do not think that the 1% lead that it has over Microsoft is enough. Therefore, Microsoft remains the king of the hill, which means that it's the company out of these three that I'd invest in myself if I had to choose. However, even Microsoft's expected return of 12% per year over 3 years isn't that impressive, and we do not feel that there's a large margin of safety that the company will beat the historical stock market average of 10%. Therefore, we will now stick our necks out and present the company we currently own. We will name it, but let's do the numbers first. In terms of historical growth, the company has had a 10% revenue CAGR for the last 10 years, without very much variance. A few analysts cover the company, forecasting an average growth of 9 to 10% for the next 3 years. The industry as a whole, the online gambling industry, is forecasted to have a CAGR of almost 12% until 2030, according to Grand View Research. Adding these factors together and doing some legwork ourselves, we expect 9% annual growth for the next 3 years. The company produces a significant amount of cash. Most of this is returned to us owners as a dividend. They also put away some of this cash and regularly use it for bolt-on acquisitions in order to add some extra growth. The distributable cash flows amount to 7%. And no, none of those 7% is required to maintain the 9% growth. We don't have to expect the multiple to contract for this company, as it trades at EV/EBIT 7 and PE 8.5. That's lower than the historical valuation, and even the historical valuation of EV/EBIT 8.5 and PE 9.5 we think is too low, given the company's operational excellence and long track record. The company doesn't trade any higher, partly due to the ESG movement, and partly due to having maybe 1/4 of company sales coming from Turkey. It usually takes a lot for a company to leave its historical trading range, so we are hesitant to forecast any significant movements. Still, EV/EBIT 9 shouldn't be too much to hope for, in our opinion, especially as interest from international investors grows, and as Turkey makes up a smaller and smaller part of the company's sales. That would translate to about 6% per year in multiple expansion. It feels good to say expansion instead of contraction for once. The risk that this stock should perform materially worse than we projected here, we believe, is low. The biggest risk is probably the growth rate and Turkey, but they've operated there for something like a decade now, so we've got some Lindy effect a la Nassim Taleb on our side. The second biggest risk is regulations, but the company has a good geographical diversification, and regulation will not hit all markets simultaneously. With a 9% growth rate, 7% from distributable cash flows, and 6% per year in multiple expansion, we expect a yearly return of 22% for this stock, with a low risk profile. Price is what you pay, value is what you get. Would you rather buy Microsoft, one of the best companies in the world, for an expected 12% return, or a much less well-known company in a less flattering industry, with what we think is a lower risk, for a 22% expected return? Well, we choose 22% over 12%. By the way, the company is the Swedish online gambling company Betsson. You'll find Betsson and maybe 10 or so other stock market holdings that we think are just as good to own right now on our Patreon, where we showcase our stock market portfolio in full. Head over there if you want some inspiration. Cheers! I hope you enjoyed this more practical type of video.